The final concept video, video number 3 in week 2, is the accounting cycle. And our learning objectives here, number 1, to understand the different steps in the accounting cycle. Then we're going to learn how to record the effects of business transactions in a journal. Then we're going to summarize them by posting these entries to the ledger. And finally, check the balances in the ledger by preparing a trial balance to make sure that the debits and credits are equal. The accounting cycle is a series of steps that the accountant performs throughout the accounting period. First of all, it begins, as we learned, by analyzing business transaction. Then we record those business transactions, classify them, and as to their effect on different accounts, and then summarize the net effect of all transactions, say, on the account called cash, the net effect of all transactions on the account called accounts receivable, and so on. Now, once we have that, we are able then to prepare financial statements. Now, before you visualize the 8 steps in the accounting cycle, you must remember and recognize what a business transaction is. Transaction is an exchange. It's a measurable event that takes place in a business that affects the financial situation of the business. That is, assets or the liabilities or the shareholders' equity, accounts of that business. Now, the 8 steps in the accounting cycle are, number 1, analyze transactions. And we do that by examining a source document. A source document is initiated by the transaction. If we buy goods from a supplier, they give us an invoice, that is a source document. And that then allows us to record the transaction in the records. If we sell to a customer, we provide them with an invoice, we keep a copy, that is a source document. We use these source documents to journalize. We know exactly how much we paid for the product and what we bought. And we journalize in what's called a journal, and we'll be looking at that later. Then we post the entries into what we call the ledger, another new term, an accounting term. Well, you've seen how we record transactions with debits and credits. Well, we post in the ledger the debits and credits, and if we've done everything correctly, then all the accounts with debit balances would equal those accounts with credit balances. And therefore we take what's called a trial balance. We're just testing our records to see if the debit balance accounts equal the credit balance accounts. If that's all well and said, we can proceed to prepare the financial statements. Now, in later concept videos, we'll go through the adjusting entry, the posting and closing, and the post-closing trial balance, but that's later on. Now, the journal. The journal is a permanent record in which we record all business transactions as they have happened. So therefore the journal is in chronological order, and it is a record of all business transactions. Now, this is what it looks like, general journal, and I'll show you the process of journalizing. For example, let's assume that we borrowed $5,000 by signing a notes payable. Well, there's 2 accounts that affect. Cash goes up, and notes payable goes up by $5,000. The way we record that in the journal is, first of all, the date. The account that is debited is recorded first. In this case, it's cash. And we put the $5,000 in the debit column. The account that's credited, i.e. notes payable, is recorded next, and it is put in the credit column. Now, this is the ledger, and I apologize for this PowerPoint. But a ledger, or it's called the general ledger, is a complete collection of all accounts of a company. And these accounts fall into 2 groups: the balance sheet accounts, which are assets, liabilities, shareholders' equity, and the income statement accounts, revenue and expenses. Now, the ledger card is this. It's the same. There's the name of the account, and it's given an account number. In here, we record the date. If we need to make an explanation, we put that there. If the account increased cash, we put the increase here. If it decreased cash, we put it here. And we keep an ongoing balance. And that's how a ledger card, we would have one ledger card for every account that we have in the business. Now each business has a record of all the accounts they have and the account numbers. This is called the chart of accounts, and it's a complete listing of all the titles and numbers of all the accounts in the ledger. It can be compared to as a table of contents in a book. Okay, the groups of accounts usually appear in order. The first group are assets, and they are generally given numbers between 100 and 199. The next group are liability, and they are given numbers anywhere between 200 and 299. Now, shareholders' equity account and dividends account, 300s, revenue accounts, 400s, and expense accounts are given numbers like 500. Here is an example. As you can see, the asset accounts all were 100 up to here. Then we have the liability accounts, 200, the equity accounts, then the service revenue accounts, and the expense accounts. These are the actual ledger accounts of a company called Micron Company. Okay, now we're going to illustrate the process of transferring the amounts from the journal to the ledger accounts. Now, we introduced the general journal before. Let's assume we had a transaction where the company sold stock for $10,000 cash to investors. The date was October 1st. The account that is debited is always written first. So we debit cash because cash increased, and we put the debit in the debit column. Common stock also increased. An increase in common stock, though, is a credit. We indent. You notice it's not on the same level. Here are debits, indent our credits, and we replace it in the general journal. Now, we're going to transfer these amounts. There were two accounts that are affected. I'm only going to show you the cash. We would go to the general ledger and pull out the cash account, account number 101, and we would put that number there, cross-reference it. The date, what happened, owner invested, it comes from general journal page 1, and it is a debit of $10,000. There's nothing else in there, so we have a $10,000 debit balance. And we would keep this account, and every transaction that affects cash, we would then post to this cash account the date, the page where that transaction is referenced, whether the transaction increased or decreased cash, and we have an ongoing balance. Now, I'm not showing you, but there would be another card for common stock. It would be the same date, same journal reference, only it would be a credit of $10,000 and a credit $10,000 balance. So that's how the journal and the ledger work together. Now, once we've completed all journal entries and posted them to all these different accounts, cash and supplies, prepaid insurance, we then total up the debits and subtract the credits, and we have the debit balance in cash of $15,200. We simply list this. This is a trial balance as of October 31st. List cash, a debit balance of $15,200. Supplies, a debit balance of $2,500. Prepaid insurance, $600. Equipment notes payable, a debit balance of $5,000. Common stock, a credit balance of $10,000. Service revenue, we add up all the debit accounts, $28,700. And the credit accounts, we get the same. So we know that if these accounts balance, it's quite likely we did not make a mistake. We journalized every transaction properly, we posted it to the ledger cards, and we summarized the ledger cards by completing a trial balance. We can then prepare an income statement. We have the revenue accounts, the expense accounts here, and the asset, liability, and shareholders' equity accounts. So that partially completes the accounting cycle.